Welcome to my show, Searching for Integrity. My name really is John Smith, and I'm looking for people of integrity. Why? Because our country suffers from IDD. Thank you very much for those words in this past, and I have some information here that I've been looking at I was asked to look at, and I have done it. So it's a mess. Is what the mess is. Economic mess in the U.S. But then, as I looked into it and began to determine the scope of all of this, we have a global situation. This is not just something simple in the U.S. It's everywhere, and it's hitting everybody else at the same place at the same time. So here we're going to talk about the recession, whether it's here, whether it's not, or whether it's going to be here, or whether it's not. And I think that you'll have an opinion, an educational opinion from this, and I hope so. I spent a lot of time on it, looking at it. I've been through a bunch of these, but never thought I'd have to write it down and talk about it. Nevertheless, I want to, first of all, define what recession is. It's an economic term, and it's a term that, let's see, right, I'll just begin here. The Great Recession was a period of marked general decline, last 2007 and 2009. So let's start with that memory. That was the credit crisis that we had here in the U.S. during 2007 and 2009, and we suffered quite a while for that. Credit was bad. The housing market, bottom of it, fell out of that just because people didn't want to loan money. You can't own homes if you can't, if somebody else isn't loaning you money. It's something that we have to live with, and it was a pretty severe. They called it the Great Recession, is how they rephrased it. My notes here and my research, my analysis of all of this is that I'm going to say we pretty much have a recession on us, or at least real close to us. It's not good in the long term. Let's go back just a second again. I'll do this periodically on the Great Recession. It's the worst economic declines in U.S. history. Officially lasted from December 7th, 2007 to 2009. The collapse of the housing market, fueled by low interest rates, easy credit, insufficient regulation, and toxic subprime mortgages, led to the economic crisis. Now, a lot of questions comes up. What caused this? How did this happen? What happened? Thankfully, we've got historians and newspapers that we can track back and see what happened and how they reported on it then, as I am mine now. Thankfully, there are always ways you can prepare for an economic recession. Let's think about these for a minute. First of all, live within your means. I think everybody knows what that means. Identify ways to cut back on spending. Grow your emergency savings. Sell your unwanted stuff. If you got stuff you want to sell, now's the time to do it. Pay down your debts. take advantage of relief programs. Do not panic sell. I believe this statement may be shining on the stock market, bond market, all of those big markets. Do not panic sell. That's a rule. And the last one here on this list, I have some others later on. Improve your education and skills. As you get an opportunity to do this, to see it, to do it. A recession is actually, it's already boiling, getting ready to come over and boil over the pot. It's something that "45 economists were surveyed recently regarding the recession and whether or not it's here or not. And the answer from those guys, economists, is saying, yep, it's coming. It's coming. And it's more than just a dip, how it's coming. Now, is the U.S. already in a recession? The Atlanta Federal Reserve in Atlanta, they have already looked at and have a leading indicator. Whether they can determine that to a degree of accuracy, it shows pretty well. And they already believe that the Atlanta Fed is right about what they have put forth. And this just came out in the last week. And I guess, again, that's a surprise to people. They didn't want to hear this soon. How about signs of a recession? You want to watch for these things if it comes to your state or your city, even your country. This has gone global. This is global. I was really shocked thinking that all of this in the U.S. It's global. What are the signs of trouble? Consumers start to lose confidence. When consumers hold back on their spending, that's a sign of a recession. Interest rates get weird. The yields on the U.S. 10-year and 30-year notes are kissing cousins right now. Hardly any gap between them at all. Factories become quieter. Unemployment shoots higher. Temps find fewer opportunities. Workers stop calling it quits. And sales of new cars shift into a lower gear. Last of these signs of troubles is stocks go on a losing streak. And you have noticed the losing streak in the last 30 to 60 days, and it's going to continue at least that much longer, possibly into 2023. So, if I were to ask a friend of mine and said, are we already in a recession? And he would probably say, you betcha. We got to start handling this and handling it the best we can do. The things that we need to look at is what's at the grocery store and how much are we paying for it? And why don't we see normal products on the shelves that we don't see? That is also exacerbating this situation. It's a something that we don't want to go through, but it's here. We don't have a choice. It's already happened. The signs that a recession is coming, and they all are that. Watch for these signs of trouble. Consumers start to lose confidence. When consumers hold back on their spending, that's a sign of recession. Interest rates get weird. The yields on U.S. notes, 10-year, 30 years, as I described, is listed here as well. Factories become quieter. Unemployment shoots higher. Temps find fewer opportunities. Workers stop calling it quits. This is not a good list because it's going to make people scared, concerned, but the U.S. probably is headed directly into recession. And there's some evidence in spreading the virus still, and Delta still around. That potential is also pushing the economy into recession. The factual formula for GDP in a recession is if it's the output, GDP, drops below the previous quarter. And that has happened. Let's see what else I have here for you. As I was saying, it's global. I made some notes here on countries already in recession, and I wrote down the ones that I didn't know were going to be part of this list. Germany is already 6.1% below their expectations. France, 8.8%, and Italy, 10.8%. That's a surprise. It is. I thought better thoughts for inventory in the economy in Europe. And we will register full year recessions. The Depression, once upon a time, the Great Depression. Let me get a little bit of water here. The Great Depression, it began in 1929 and it lasted until 1934. Now, that's a depression, much more than a recession. 1934 to 1941, it lingered upwards. What saved the U.S. at that time was Hitler and war. And it got the country back together, and the factories going again for what? For guns and airplanes and artillery and all those things that we were going to need. Ships. Boats to my Navy friends. They're going to like that. And they, after that, the economy was somewhat on track, and it did eventually pull out around 1950, after the war was over, World War II. The Great Depression was really something. Had about a lot of movies made on this. Like the Great Depression, it was a balance sheet recession. Now, what is a balance sheet recession? Well, if the Fed doesn't deal with the money that it has and gets it into the system, the security system, then we're going to have a problem. We'll have a balance sheet recession, and that's what happened with the stocks in the recession. In the Depression. Like the Great Depression, it was a balance sheet recession. This involved falling asset prices, which we are looking at in the stock market now. Stock market is in a bear market. Bear market is graded upon it being at least 20% below its previous marking, and it could go as low as 40 or 50%. There's no way to stop it if that's what's going to be. So falling asset prices would certainly be an element that would push us into another recession. Bank losses from bad debts, that's something else. They're going to be looked at soon because when the loans don't come in, the loan payments don't come in, especially in the industries of the economy, then the banks are going to have bad debts. Consumers try to pay off debts incurred in years leading up to the recession. That's an indication, and that's what you should begin now as much as you can and still maintain your liquidity, would be to pay off your debts as much as possible. Because debts are a drag on you and me. If we've got one and we got to have to make that monthly payment, it's got to come from somewhere. Dynamics of the euro also made it much more difficult for countries in the Eurozone. The UK has already had a double dip recession, which doesn't sound good to me. Similar items when you hear people talk about a recession. Somebody could call it a downturn, a depression, as I have, a slump, a slowdown, a trough, a credit crunch, a credit squeeze, stagnation, stagflation, hard times. Excuse me. And the opposite of these similarities, a boom is opposite and an upturn is opposite. Will the U.S. economy suffer a recession this year? Here's another answer. The risk of the U.S. economy sliding into recession this year doubled last week after the Federal Reserve implemented its sharpest interest rate hike since 1994. According to Goldman Sachs economists, the investment banking giant now projects 30% chance of recession over the next 12 months, up from its previous forecast of 15%, so it's doubled. That's, as we would say, and well, I'm still saying it even though I moved from Texas to Arizona, that's no bueno. That's a way I can put it for a lot of people that they will understand. And I did say that the stock market could crash another 20% or more if it plunges into recession. Causes of recessions. We've gone through those and we're on the lookout for those. A financial crisis. If banks are shortage of liquidity, they reduce their lending and this reduces investment. A rise in interest rates increases the cost of borrowing and reduces demand. A fall in asset prices. Negative wealth effect leads to less spending. Fall in real wages, e.g., example, inflation outstripping nominal wage increases. Fall in consumer business confidence, also exacerbated by the negative multiplier effect. Appreciation in exchange rate. Exports less competitive. Fiscal austerity when government cuts spending. Trade war. Global economic downturn. And I think what we're seeing in Ukraine is going to have a bearing on all global economies, especially food. Where is it? Where are we supposed to get it? None of this is looking up. I wish I could. I ran across some interesting information about the same topic. Are we in a recession? Here's the debate. The long-term driver of inflation and the reason we have so much inflation is the fact that we printed $6.5 trillion in 48 months and grew the money supply by 40%. That's when Biden was throwing all that money around the last couple of years. That is simply what's driving all of this, and all of the other things are just short of add-ons to the supply chain. No, the longer-term structural issue is the fact that we grew the money supply by $6.5 trillion. That's what's driving inflation at the end of the day. It takes 12 to 18 months for all that government spending to get into the system. In April of 21 last year, inflation jumped from 2.7% to a little over 4%. It got above 5% in June last year, above 6% in October, above 7% in December, and it was 7.9% in February of this year. Annualized rate of 10% in February. So we were already at that level, and when Russia walked into Ukraine on February 24th, since then it's now at 8.3%. We've got 5.2% of the inflation between March and February. What can I say? This is serious stuff. Russia invaded Ukraine. I understand the oil market is one thing. I'm talking about broad-based overall inflation. And you're seeing double-digit inflation across all sorts of commodities. You're seeing producer prices well into the double digits, and that's going to have to get passed on to consumers at some point. I see a much larger, broad-based reason for inflation than just the geopolitical. If I need to bid up my wages to draw people back to the labor force, I need to sell my product for higher prices. There are 10.5 million job openings right now in the private sector, but only 5.9 million people are unemployed. We're not counting those people who are out of the labor force. Also, about 4.3 million people a month are quitting their jobs and looking for something new, so they're moving around looking for better offers. The Great Resignation was a big deal, but it might become the great "can I have my job back" as people start to feel the pinch. Yes, I've heard a lot of that as well. It's a matter of listening to the government, the Federal Reserve. George Carlin once said, "I have certain rules I live by. My first rule is I don't trust anything the government tells me." And that, of course, is one big lie. Again, we can't trust the Fed. Just a few weeks ago, 2 weeks ago, they said that they were not considering a 75 basis point, 3/4 of a point increase. And then guess what? 2 weeks later, they did it. They just cannot be trusted. What you hear and what you see are two different things. This is more material that I have, and I probably have overwhelmed you a lot with this. It's difficult for me because I know that you're being surprised now, unless you know a good friend that's an economist. But it's not going to get much better, is how I put it. Same with the stock market, the economy overall. And I want to say, though, I didn't come with happy medicine today. I want to thank my listeners for listening and tuning in once again. And happy trails to all.